afternoon and welcome to Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. Kelvin Wong, market strategist at CMC Markets, is our guest today. Kelvin, good afternoon.
Yeah, good afternoon, Brian. Good to see you again.
Now, before we speak to you, Kelvin, and get your insights, let's take a quick look at how markets across the region are performing. But first of all, we'll start with the crypto markets. Bitcoin is at 29,838.4. It's down 1.78%. Ethereum is at 2,037.98. It's down 1.88%. Now, looking across the regional stock markets, we'll start where you are first, Kelvin. The SGX is at 3,228.94. It's up 0.84%. Over at KLSC, the KLSC is at 1,554.76. It's down it's up 0.4%. Shanghai is at 3,083.73. It's down 0.32%. The ASX All Ordinaries is at 7,416.3. It's up 0.89%. The Nikkei is at 26,834. It's up 0.65%. The Hang Seng is at 20,457.5. It's down 0.68%. And rounding up the numbers, we've got the Kospi, which is at 2,621.93. Just up slightly at 0.06%. Now, Kelvin, pretty mixed markets today. Tell us why.
Yes, but overall, what we could see over here is, it's a kind of pretty mixed bag for the ASEAN, the major ASEAN stock indices. So on the positive side, what we see over here is a bit of a positive spillover from the overnight rally that was actually seen across in the major US stock indices, all the way from the Russell 2000 as well as the Nasdaq 100. So what's interesting over here is that the current rally of this major US stock indices seems to be driven by hope. That's hope saying that there's a possibility that there could be, we call it valuation has come close to a very cheap level where actually investors will actually starts to kind of buy the dip. Okay, but on the other hand over here is that if you look at certain aspects of the market, there's still some risk going on. So if you look at what we're seeing now in Asia itself over here is that yes, even though from China yesterday actually the officials from Shanghai actually kind of give a bit of guidance saying that this close to about 6 weeks plus of stringent lockdown in Shanghai is about to ease because of this. I think there's close to 3 consecutive days where they have 0 COVID infection outside the kind of not within the quarantine areas. But on the other hand, we start to see Beijing cases starts to flare out again. In fact, today they actually reported an increase in COVID cases. So overall, there's still a bit of mixed, we call it news flow. But what's important to share with the audience is there's this 2 intermarket instrument that I tend to watch very closely to give me a gauge about whether the recent rally in this global stock market, if you look at taking the US stock market as a proxy, whether this last 3-day already is it sustainable or it's just a tactical rebound within a major and downtrending phase. So the first one I'd like to share with you is this US 10-year Treasury yield. So take this US 10-year Treasury yield as a global benchmark for cost of funding. So cost of funding as in for corporations and as well as a benchmark for even the housing loans. So what we could see is that since March this year, this 10-year US Treasury has actually started to rally pretty significantly. And bear in mind, this rally actually comes hand in hand with that recent 3 months of downturn that is seen on the US stock market that spread towards the rest of the world as well. And what's interestingly, in the middle part of last week, you start to see a pullback in this US Treasury yield. So this pullback in US Treasury actually coincided with this last 3 days of rally that's been seen on the US stock indices, as per se the global equities in general. But what's interesting over here is that yesterday, if you look at yesterday price movement, it started to actually shape a bounce and form a higher low. So what it implies over here is that, very interesting, this higher low is formed right above a near-term support at 2.72% on the US 10-year Treasury yield, and also above this 50-day moving average giving us a gauge of this medium-term uptrend that is still pretty much intact. So we could see yesterday's price action on the US 10-year Treasury yield indicate to us that there is a high chance that we may start to resume this rally in this US 10-year Treasury yield and may take us up to higher high towards the next resistance at
Yeah,
3.44%.
and Kelvin, this is what I mean. U.S. Federal Chair Jerome Powell said that he would back interest rate increases until prices begin falling back towards a healthy level. Now, that's a pretty strong statement. What impact
Yes.
do you think that will have on the thinking of central banks in the region?
Okay, so overall here, based on Powell yesterday hawkish guidance, right? So what we could see over here is that what's I'm pretty much concerned will be firstly we'll talk about China first, because China right now the situation is a bit dicey. Why? Because very clearly, if you look at the key economic data out from China, the one on Monday, the industrial production and retail sales is very weak. Yeah, so very clearly, the first half of the year for China, we are now facing the risk of a very sharp contraction in terms of economic growth. So that's right now, as you just say that some economies has really started to downgrade China growth to actually below 5%. Some talking about 3% to 4%. So that's way below the official target of around 5.5%. So the only way for China, right, to actually negate this current economic slowdown they are facing is they got to do monetary policy stimulus and fiscal stimulus. Means we're talking about expansionary policy, targeted one. But on the other hand, over here is that because right now, if the Fed keep hiking rates until the point, because right now the Fed is actually very clearly saying that, hey, I'm now watching inflation. If inflation don't comes down, my interest rate hike will continue. All right.
Yeah.
So over here, there will be a big differential between interest rate instruments, without fixed income instruments, between China and US. So US will start to yield a higher premium over China fixed income instrument. So right now over here, there's a policy over here that it could actually, if this China PBOC starts to actually sway towards more on the dovish side, we talk about expansionary policy, where they will start to reduce rate more aggressively to actually meet the official target of 5.5%. There's this big risk of this capital outflow out from China because of the fixed income instrument between China and US is the premium of US is definitely more attractive. So that being said, over here, right, there will be another we call it leg of this downside pressure on the renminbi, the Chinese yuan itself. So people, especially the Chinese central bank, they will actually have this delicacy or a frustration that, hey, if I reduce interest rate too aggressively, there'll be risk of capital outflow.
Yes.
So that definitely will have a negative adverse impact on the China economy, and as well as it will actually cascade down to our region as well. So this is something that our region is going to be very Asia region we're going to be closely watching in this aspect over here, because overall actually indirectly it lead to a global tightening situation where it does not bode well for our ASEAN region as well.
Now, Kelvin, as always, thank you very much for coming on the show, and thanks for your insights.
My pleasure, Brian.
Now, we've been speaking to Kelvin Wong, market strategist at CMC Markets, on Biztech's Asian Midday Market Watch, powered by Rajhi Bank Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as Rajhi Bank's social media platforms. Thank you very much for tuning in.